Welcome to our first interview for 2024 of Econ Thoughts, the podcast series of the Society for Professional Economists here in the UK. Today, I'm very glad to have with me as a guest speaker, Ricardo Reis, who is the Arthur Phillips Professor of Economics at the London School of Economics. Ricardo has written extensively around monetary policy and inflation, and most recently wrote with Markus Brunnermeier the book A Crash Course on Crisis, Macroeconomic Concepts for Run-Ups, Collapses and Recoveries. Indeed, very topical over the last few years. Today, we'll explore some of the themes from the book and some of the other academic papers that Ricardo has written over the last 2 decades. But before we do that, Ricardo, could you spend just a brief minute explaining how you got where you are today and also what gets you excited about working at the LSE?
Sure. So I am currently the A.W. Phillips Professor of Economics at the London School of Economics. That Phillips is the one from the Phillips curve, or so as my wife puts it, I have a curvy chair, since it is the Phillips chair, which is a curve. And I got there initially from having done my PhD in economics at Harvard 20 years ago. I taught at Princeton for a few years and then at Columbia for a while before joining the LSE about 8 years ago. My work has been very much on things around macroeconomics, a lot of it on inflation, expectations, Phillips curves, as well as on automatic stabilizers, fiscal policy, macro financial crisis. And even more recently, I've been doing quite a bit of work on the renminbi and international currencies and others. Aside from research, I've always been very interested in applied topics having to do with central banking, and I've studied many things having to do with the balance sheet of the central bank. How do we think about its liabilities relative to public debt? And that has led me to quite naturally be a consultant for many central banks or serve on many advisory boards of that type. Finally, I am originally from Portugal, and I've stayed connected to the country in terms of providing public service, and over the last decade, mostly by writing an op-ed once a week in the main weekly newspaper in the economics section. So that's a little bit of where I am today.
Oh, thank you, Ricardo. That was very helpful. And it's good to know that you still maintain the connection to your home country in Portugal in the same way I always try to connect to my own in Italy. I think moving on to the bit of a conversation, obviously some of the topics discussed are central to the economics debate today. And as we sit here now at the top of the kind of monetary tightening cycle, somebody call it whether it's a Matterhorn or whether it's a tabletop mountain, and we look down to the descent towards kind of lower rates, and we try to figure out whether that descent down the slope is going to be fast or slow. It is always important to understand a little bit how do we get here in the first place. So you wrote a very kind of timely paper in 2022, and looking at the origins of the current inflationary cycle, and obviously some of the work of the last 2 years has also been focused on that. It would be great if you could outline for our audience your thinking around what actually created and caused actually the current inflationary kind of crisis cycle, and also whether actually there was something that the central banks did or did not that could have avoided some of the recent kind of inflation increases, or whether actually there was not very little they could do and it was all baked into kind of some supply kind of chain trends.
Let's start with 2 fundamental principles which will guide my answer to your question. The first one is that inflation is always and ever about what is the central bank up to. After all, what is inflation if not a change in the price level? What is the price level? How much do real things like water bottles or chicken cost in terms of pounds or dollars or euros? And who is the monopolist provider of euros and pounds? It is the central bank, ultimately. Therefore, any story about inflation that does not mention the central bank and monetary policy is incomplete. And so any story that talks about the inflation of the last few years has to mention the central bank first and central. Second fundamental principle is that central banks have, for a while now, and certainly all the major advanced ones, had a very clear, explicit target of 2% inflation. They try very hard to get it. They're very independent in their pursuit of it. And so any conspiracy theory that would say that they want inflation just falls flat against both the mandate, the evidence, as well as their success. Before 2020, for the previous 20 years, are the most successful period of inflation control in history since we've measured. Gold standard, rocks and stones, gold, Bretton Woods, whatever you want, nothing was as good between 2000 to 2019 across all the major economies which you have data in terms of inflation control. And it's not like the central banks all of a sudden woke up and said, let's choose violence. So given those two principles, the second principle means that it has always been a shock that caused inflation. And so any diagnosis has to come with what shock led to the central bank not being able to keep inflation at 2%, and two, what did it do to let it go away and bring it back? With that in mind, Filippo, let me then answer your question. What caused inflation to accelerate in 2021? The shocks. What were the shocks? A pandemic, of course, in 2020. And a pandemic that not only led to vast lockdowns and declines in economic activity in 2020, but especially came with a very fast recovery in 2021. The people who had been locked saved their money, and as soon as they were out, they went as quickly as they could to spend the money that they had saved, putting upward pressure on prices. At the same time as in 2021, what happened was that even as demand recovered immediately, supply was much slower to recover. The pandemic caused damage to a series of supply chains of companies. The fact that different regions of the world, China had relative to the US and Europe, opened at different times and had locked at different times, meant that there were quite a few months where supply was slow to recover. Well, that imbalance, that shock, caused an inevitable amount of inflation. And let me be clear. There were certainly some misdiagnoses shared by not just central banks, but pretty much all economists, or not all, but a majority, when we expected that things would not recover as quickly in 2021. Mm-hmm. To be clear as well, the payoffs were asymmetric, meaning we were more worried about the prospect of a depression in 2020 than about the prospect of inflation. And I think rightly so, central banks pursued very expansionary policies, as did fiscal policy in 2020, therefore further pushing up demand. What that meant is that this very understandable misdiagnosis plus a shock meant that pretty much no matter what central banks would have done, or unless they were incredibly clairvoyant and had already started in September of 2020, understanding what was coming and adjusting policy to it, we would always have had an inflation coming up. So a misdiagnosis and the shock was clear. But second, Filippo, then we get to the actions of 2021 and the actual, let's say, more policy mistakes. And the policy mistake was that by the middle of 2021, maybe early summer, maybe even earlier than that, but certainly by September or the beginning of the fall of 2021, it was, I think, clear in the data that inflation was not just going up, but also that there was a strong sense that this would be persistent, in the sense that it wouldn't be just a 2-month blip in the price level. Why? Because in part, what you were seeing in the expectations data at the time was that as inflation went up, it's not that people were saying, well, clearly now inflation got up to 3-4%, but it's going to come down very quickly. You'd start seeing very strong signs in the expectations data, firms and households, that they thought this was going to persist. Well, once a blip starts leading to expectations, well, then people start changing their prices based on those expectations, and that leads to a persistence of the shock to start with. So the expectations data and the impact on that showed that this was starting to persist. At the same time, I think most central banks were slow to act. They were slow to act for different reasons, but I think there were 3 reasons, mostly. First, there was, I think at the time, a little bit of a forgetting of economic theory of what causes inflation, a little bit of losing the forest for the trees, and having a too benevolent view of the data when looking at, because there were so many relative price changes then because of supply shocks, some sectors booming, some sectors falling, some relative values going up and down, it was easy to get lost and say, well, all of this inflation is not really inflation, it's just some prices go up, some prices go down, but the overall is fine. I think looking back, there was a forgetting of the key economic principles of what determines inflation, namely having to do with a very loose monetary policy. Second policy mistake, so a first one is a little bit of a misdiagnosis for which we can be much tougher than we were in 2020. Second one, in terms of actual policy, comes what I like to call an obsession with the low R-star view of the world. Remember that for the previous 10 years, central banks had been fighting a perception that because normal interest rates were on average very low, that left the central bank with very little room to cut interest rates whenever inflation turned out to be below target. And that led to a view of the world, the low R* view of the world, that we would often hit zero lower bound where we wanted to cut more rates and couldn't. And as a result, that led to very clearly in the flexible average inflation targeting adopted by the Fed, but across all central banks, the view that whenever you had inflation going up to 3.5, 4, that was actually a good thing because it allowed a re-anchoring expectations at 2, it allowed to fight this zero lower bound and so on. Well, I think that led central banks to being very slow on the ball when they saw inflation going up to 3.5, 4. They said, well, hey, that's a good thing because, we were stuck at 1.5. It's good to go to 2.5, 3 for a little while. And then when 3 became 3.5, oh, that may just be measurement. And when 3.5 became 4 again, this very intellectual anchor of the problem is deflation, the problem is not inflation, led to being slow on your feet when it came to changing interest rates for certainly a few months. And then third mistake, I think a third mistake was still coming from, was the use of the balance sheet. You can't forget, Filippo, that we were doing quantitative easing, very aggressive quantitative easing, not just in 2020. We doubled the balance sheet of ECB and the Fed between 2020 and 2021. But more importantly, even as the housing market was pretty hot and tight, say in the US in mid-2021, the recovery, we were still buying mortgage-backed securities at a rate faster than ever. It took a long time, partly because of the fear of disturbing financial markets, to say, look, we should stop buying this. It was a perception that things had to be very gradual, very slow. And that again led to a delay of months where we were still doing QE way into inflation being well above target because of, for lack of better words, financial dominance, a fear that any shifts in QE policies and balance sheets would cause some great Armageddon in financial markets, which led that persistent policy to stay. So you had these three mistakes leading to central banks having much loose monetary policy for 6 months for a while. And then finally, together with all of these, you need to talk about fiscal policy. Fiscal policy, because it both is a shock as well as the way it affected the expectation of persistence. On the one hand, large fiscal stimuli in 2021, further adding to the shocks that pushed up inflation. And on the other hand, this very large debt and a large neglect towards it, which may have contributed to some of the expectations, credibility shift of households and firms and investors going forward. So I think it's a combination of the shocks, bad policy in 2021 led to tightening that was 6 months too late, maybe as much as 9 months too late, and a fiscal policy further pushing for a large persistent inflation.
Thank you, Ricardo. That's very helpful to outline in that way. A couple of kind of follow up on that. On the monetary policy response, you mentioned a little bit that a bit too slow, stuck into the kind of low R* mentality. Was it much about they were not used to see inflation at that level? It's been for a number of years that the central banks had been fighting inflation. Therefore, there was a little bit of naivety, a little bit of complacency. Or was it actually that the models that they were following or the framework that was established, as you said, the flexible framework was established in 2020 for the Fed? Was it following that created the slow response? Or was it just that some of the bankers were not used to fighting inflation for such a long time that almost they forgot how to do it?
I have told you what I think were the main factors contributing. A hard question, which there's a lot of wonderful research being done right now, is putting weights to the different factors, to the shocks, to the policy, to the fiscal monetary interactions, and seeing how much it is. As usual, there were some people who will claim it is all one of them. You should always mistrust those people. It was always a combination, certainly, of all of these ones, the supply shocks, the expectations, the policy, the fiscal. It's going to be a mix of these four with some weights. And figuring out exactly how much of which is each one is going to take not just a lot of research, but certainly books for 10 and 20 years we're discussing. In the same way that we're still discussing the 1970s inflation, exactly how much was the weight of different factors. Now, among the four, let's pick on one, the monetary policy, if you want, delay in response in 2021. Likewise, within those, we can assign different bits to it, and we have to work quite hard to put weights to them. And you've already mentioned some. Certainly, I think the frameworks were maybe put a little bit too much weight on the low R* view of the world, which I think was already a little bit out of date, and put a little bit too much weight on the fear and the dangers of the ZLB. There was some of maybe among some staff, a lack of, if you want, historical background and understanding the determinants of inflation and looking beyond the last 20 years. I think we could certainly point the finger at that. Thirdly, I mean, I really don't want to sound too tough on the central banks. It was a lot of noise in the data in 2021. Diagnosing it is hard. As I said, I think, for instance, the QE is a clearer mistake. But on the other ones, it was really noisy. You even look at the data revisions now, and, you know, again, with the benefit of insight, we should have been tightening, I think, in the summer of 2021. If you look at the real-time data then, it wasn't clear at all. I mean, I think a point could have been made or not for that. And then finally, I think there's a fourth one, which is, if you want a communication side, I think there's a fact that, let me state a fact, which has to impress you a little bit. Throughout 2021 and even in 2022, even as the world was complicated, the data was messy, and I think exposed, most would agree mistakes were made, every single vote at the FOMC was unanimous. That's a little striking. I mean, you would think that some people think one way, some people think in the other. I mean, the Federal Reserve System was created with regional Fed so that people would come with different views to the table or not. Now, maybe this was because people were disagreeing strongly, I think what the minutes show, but felt that they needed to show a unified front. Maybe it's because there was a little bit of groupthink, certainly when it looks also at central banks. Or maybe it's because commitment was taken too seriously. Let's think about QE, or even let's now point the finger at ECB, when there was a very strong feeling that for guidance, there was a promise when it came to bond purchases and interest rates that would extend all the way to 2022, and there may have been a little bit of sluggishness to come back to that. Again, I think you can point to several of these. I find that as a scientist of these things, very hard to put weights on all of them. I think there's some argument to all of them. I think more than pointing fingers, I think it's better to fix systems at the margin, fix the models a little bit. I'm certainly not of the view that the models failed dramatically. And actually, I think they need a little bit of tinkering on the side. I think on this, how committees work, unanimity and others, I think there's some reforms to be made on groupthink. I think on the diagnosis of the data, as I said, in my sense, it was just too much empirics and too little theory. I think a little bit more theory, fell in love a little bit too much with data for too long. In terms of, again, the history of economic thought, I link that with that. I mean, an importance of not being stuck on the last battle, which is true of any organization, including the one of, I think, most of the listeners here, to be too focused on the last 10 years and forget the history of things. I think you can point a little bit to all of them. Putting weights on them, I find it extremely hard.
No, absolutely. And in fact, there'll be a lot of, as you said, discussed for a long time, even the impact that the fiscal policy actually had and how much was compared to the monetary policy, definitely. One of the, moving on a little bit beyond the 21 and 22, kind of one of the explanation why probably inflation has not really spiraled out of control, potentially, and is the issue of around expectation, which you mentioned earlier on. And obviously there was an IMF paper that from October last year that looked at the difference between short and long-term expectation and how actually the short-term expectation may have a larger impact on inflation dynamics than the long-term. First of all, would be any kind of your views on that IMF assessment, but more importantly, how anchored were the inflation's expectation during the last 2 or 3 years? Did they help actually keep inflation in line, and are they actually bringing it down now? So what's the role of expectation that they play over the last 2 or 3 years?
So I split my answer into 3 parts: theory, empirics, and right now. Empirics of the past and right now. Let's start with theory. Expectations are central to any story of inflation, okay? Anyone who tells expectations don't matter for inflation really has it very deeply wrong in terms of how they think about economic theory. Why? Because one of the most fundamental results that you have to learn in class 1 of inflation is that there is a fundamental indeterminacy in classical Marshallian Walrasian economics about the price level. Ultimately, relative prices is what matters. The units in which you denominate things, whether they're dollars or cents or euros or pounds, in the same way that whether I say your height is 1.80 meters or 180 centimeters is not pinned down by real things. It is only through the expectations of when I ask you how tall are you and you say 1.8, my expectation is, knowing that you're Italian living in London, you must mean meters. And therefore I understand that that's 1.8 meters, not that that's 1.8 feet, which would be ridiculous, of course. And so expectations are crucial whenever we talk about units of account, and the price level is unit of account and inflation is unit of account. You cannot coherently talk about inflation without mentioning the expectations. So let's start with that important theory concept that as people start talking about, do expectations matter in this episode in the sense of this measure or that measure? Let's not forget that ultimately expectations matter hugely, okay? They are in some ways, in some theoretical limit, the only thing that matters almost. Everything else is how it shapes expectations, behavior, and others. That's first. Second, empirics. However, the difficulty with this theoretical principle is that there are many measures of expectations, all of which are very problematic, noisy, and take a lot of work to measure. I am not discouraged by that, Filippo. Heck, measuring the output gap, a very important principle for demand and supply, is incredibly hard. We have 35 measures. It's very noisy. We're updating them all the time. No one in their right mind would not try to measure whether there's an output gap or not, whether markets are slack or not. Even measuring growth per se or inequality are very hard. That doesn't mean you don't measure them because you understand how central they are to human welfare. So the same applies to expectations. It's very hard to measure them. But at the same time, we've put a lot of work into it. And so whenever you have someone just plot some silly measure of expectations, so, oh, look how noisy it is and make fun of it, again, that speaks poorly of the intellectual honesty of the person doing that, more than of the problem of expectations. Yes, it's hard work, and yes, you have to do it, and you have to combine many different measures. With that in mind, I think let's now look to the part of the actual data, having done the theory and the empirics. What you could see in 2021 was that, and this is a common find that literature has shown, is that, first, short-term expectations overreact. They react too much. They often are a little noisy. They're driven by noise in others. But the virtue of them is that, like with any overreacting thing, they give you a lot of signals. With noise, with a lot of signals. Long-term expectations have the issue that they move very little. And again, I mean this in the data. They move very little, and so by the time they move, you're behind the curve. But what you can do by combining the noisiness of short-term expectations and the importance anchoring of large expectations, because when large expectations move, they really move in a very, very persistent way, and they're very hard to re-anchor. What you can do is look at the whole distribution of short and long across people. And I think an important lesson that's been shown from that, from the literature on what's often called disagreement, is that you can really learn from second and third moments in a statistical sense, and more generally by plotting the distribution and seeing that even when the medians aren't moving very much, seeing tails emerging in persistent ways in the short-term distributions tell you that something is moving in a more reliable way than just the median moving up and down with its noise. Then when you see some transmission from those into financial markets in prices of things like insurance against the long-run inflation, boy, if you see a correlation in the five-year with what's going on in the short-term tails, that tells you a lot. And that finally, you'll see something in the long-term expectation serves, if you want. So there's a bunch of patterns in the data that we can see across countries, across time, that happen usually whenever inflation is really getting an anchor in that sense. And a lot of those signals were there in mid-2021. So that's a sense in which the expectations data, which is noisy, and which in normal times, meaning 2010 to 2019, 2019, often the expectations data, the signal to noise ratio is low, meaning if you're just measuring output gaps, wages, the usual things, measuring inflation, the expectations you should always keep an eye on, but they don't add a huge amount on whether inflation is going to be 2.3 or 2.1. But in turning points, when inflation is about to go to 4 and 5, the expectation data really shines. It was as a rough approximation, it was the economists that most look at expectations that were screaming in the middle of 2021 that inflation is coming and it's persistent. It really was that. The expectations data was the best friend of a forecast of inflation in 2021. It was by far the thing that screamed the most in that way. So but again, you have to know what to look at it. You couldn't just plot again something out of Fred. That wouldn't help you. Finally, what about now? Well, what happened yesterday today is that after they screamed out loud in 21, starting in the middle and then throughout the end of 21 and 22, that something was coming. And by this, I mean the surveys, the options data, the swaps data, all of them in the full picture. What you saw is that when the central bank started tightening and showed that they were serious about it, let's date it as somewhere around mid-2022, they really started re-anchoring. And so by, I don't know, mid-23, the expectations look like completely back into everyone believing that we're going to go down to 2.5% inflation. And so by the end of 22, 23, the expectation data was also screaming that it's going to be okay, meaning the persistence, even though the inflation persists for a year and a half, it was going to be coming down. And lo and behold, things really did come down. At this point, especially, they were not the only signal. There were other things pointing to it too. But what we've seen in inflation was really much on the tea leaves of the expectations data about a year to a year and a half ago, in terms of it just coming down at a very strong way. And finally, the expectations, but are we going to end up at 2 versus 2.5? The question people are asking now. We're back on that, Filippo, to the fact that for that, decisions data is not great. Decision is great at telling when 2 is going to go 8 and that the 8 is going to go back to 2 to 3.
Yeah.
Are we going to be stuck at 2.5 to the expectations data? Just isn't great at doing those fine distinctions. There you have to look at a bunch of other things.
So the long-term expectation didn't really move that much, and they're still not telling you much.
As I told you, a lot of noise. But let me tell you my reading of that noise. What I think I see in the expectations data is that, especially in financial markets, there seems to be clearly another 20 to 30 basis points where they've stabilized above to what was normal pre-2019 and closer before. Now, how much of those 30 basis points are a probability being put by people buying insurance as inflation that the inflation target is going to be 3%, revised to 3%, or that the Fed and the ECB are going to be happy with inflation being hovering around 3 instead of 2? Maybe a little bit of that. The other side is how much of it is just risk premium. The fact that bondholders having been burned in the last 2 years by the inflation surprise are now requiring another 10, 20 basis points of compensation from any nominal asset that will show up in inflation expectations. My own estimates is that the 25 basis points that long-term measures are showing is that it's roughly 10 basis points of high actual expected inflation higher and 15 basis points of higher inflation risk premium. That's my estimates with big standard errors around them.
Yeah, no, that's good. Thank you. And now going back actually to the inflation, the interest rates and the kind of the tools that the monetary policy makers have. Now, you mentioned earlier on about the previous regime, about the low R star, and now we are here now. The inflation is coming down, interest rates is going to be expected to be cut, and whether it's early summer or not, and how many is subject to debate. But where will we end up? Where is the long-term trajectory as R star shift? There was obviously kind of more recently kind of a speech by kind of Isabel Schnabel looking at the rising R star. There have been a number of conversations and people that have said, we are going slightly higher. Has it moved? Is it going to be higher, or are we going to go back to where we were a few years back?
Right. So I started looking at this quite intensely last summer. And in August, in a panel debate at the European Economic Association, I was in a panel with Pablo Hernández de Cos, the governor of the Bank of Spain, and I put out my view, which I've refined since then in several talks, and which actually Dr. Isabel Schnabel cited in her speech, one of my versions of it in December. So let me tell you what my perspective on this is. First, that it is important to draw a distinction between two R stars. There's the R star, which is the long-term level of government bonds. And there's the R star, which is the long-term level of returns on private investment in the economy. The difference between the two is not just risk, because there's risk in both of them in some ways. The difference between them is that we have segmented financial markets, and that those who invest in government bonds are not the same as who invest in the real economy. And so when we're talking about R star, we need to keep in mind that wedge. Why? Because when you look at the last 20 to 30 years and the measures of the fall in R star, they are almost entirely about a fall in the return on government bonds. You look at the return in private investment, and this is research I had done 2.5 years ago, it's very flat. So the wedge has to be a very important part of the story, because the low R star view of the world was really a low government bond R star view of the world, not a low returns on investment view of the world. Okay, so let's start with that. Starting with that, what do we see? I think we already saw last summer when you think through the determinants of this R star. Well, what are the reasons why R star fell in the first place, taking, again, in mind this wedge view of the two? First, it was that China and many other emerging economies were running large current account surpluses, were saving abroad, and given the capital controls, the Chinese government, which controls capital outflows and what the Chinese invest in, naturally had a strong bias towards government securities as opposed to buying private assets in the West. That drove down the R star and government bonds very strongly. But, Filippo, what changed? already before the pandemic. China's current account surplus went away already before the pandemic. Now it's coming back a little bit. Second, the geopolitical tensions mean that the Chinese authorities, which control capital outflows, have in gross terms trying to move away from US treasuries into other assets. The combination of those two is that pushes up the R-star in government bonds. Pushes up the R-star in government bonds both because there's less savings glut, as Ben Bernanke famously called it, as well as less directed to the government bonds. Factor number two, what happened in these 20 years to drive down the R-star was that there was this great appetite for government bonds because of their safety and liquidity, to which contributed the financial regulation, the perception of high risk in private assets after the financial crisis, as well as all the QE policies and all the very strong interventionist policies of central banks to keep treasury markets going. What have we seen in the last 2 years in the pandemic? A lot of public debt at the same time as central bank balances are falling. Certainly a perception that the government debt is not that safe. Why? Because of the inflation risk. As I told you, the bondholders got killed in the last 3 years. So they cannot look at government bonds as being quite as safe as they were. And third, a rebirth of the private securities market with more and more issuance of safe things across the alternative investment classes. And so what you see is R-star going up from that factor as well. And finally, thirdly, the third thing that had driven R-star down was that investment had been very anemic in the decade before the pandemic because of a productivity slowdown and austerity. So both private and public investment were low. What have we seen since the pandemic? A huge boom in public investment and a big boom in private investment as we pursue artificial intelligence and other technologies. Again, that increase in investment absorbing the savings leaves less savings for the government bonds and means the R-star there goes up. So all of the determinants of R-star have gone up. By my estimate, something like 1%, maybe 1.2. Add to it, by the way, the 20, 30 basis points of the higher expected inflation and risk premium we talked about earlier, and end up with a new normal level of the nominal rate that is roughly 1.5% higher than before. Filippo, what was the before? For the Fed, there was a perception that the long-run steady-state level for, say, a federal funds rate was around 2.5%. Add this up, you end up with 4% as the new normal for the federal funds rate. For the ECB, it was more like 1.5. Add this up, you end up with 3%. So that says that if the new normal federal funds rate is something like 4%, once we start cutting, we'll have maybe 5 cuts. If the ECB's new normal is something around 3%, that means that again, when we start cutting, we'll have 4 or 5 cuts. Add to this, certainly, let me not sound too precise, add to it certainly wide confidence bands. But I am of the view that the new normal level for policy rates is closer to, let's focus on the Fed, 4%, maybe 3.5, maybe 4.25. That means that we are in restrictive range right now, but we're not that restrictive. That means that when we start cutting, I think we're going to learn that we settle at a much higher level than before. And I will note also that, by the way, 10-year treasuries have been trading at around 4-ish%, 4.1, 4.2, consistent with usual numbers of term premium. That means that the markets aren't too far off from what I was just saying by my use of economic analysis back in the summer. In some ways, when I was saying this in the summer, I remember people were saying, I think you're crazy, and the markets don't show that, but the markets have moved in this direction of a higher interest rate world moving forward.
Yeah, that's interesting. I think your 4% is probably slightly higher than what I've heard kind of for a number of comments. They're definitely focused more, yes, higher than before, but you're looking at more on a 2.5 to 3% for the, or maybe 3% for the Fed rates. And
I think the previous estimates were 2 to 2.5. People have updated to 3, maybe 3.5. I'm certainly, I want to be clear on this part of the video. I think I'm on the tail of thinking that's 3.5 to 4. That's the range going forward.
How long will that last? Are you in there for a kind of a cycle? Is quite a long time, or is it that 5?
Yeah, the new steady state, but you know, steady states in economics are both infinity in the absence of shocks. So forever, as well as because there's new shocks will come for sure. In 5 years will be different. Yeah, they're forever with probability 0. That will be there forever. If you the mathematical real analysis joke.
Thank you. We almost ran out of time, so probably have one kind of last question. Obviously, he's picking up a little bit on your book about kind of course-on crashes. If you look at the COVID-19, will you kind of was a typical crisis or not? And also, have you learned anything going forward in terms of what policymaker might need to do? or is it we need to go back to the financial crisis or the last financial crisis that might teach us something?
So Marcus Brunemeyer and myself spent the last 6-7 years collecting notes and thinking about what have we learned from the great financial crisis about macro finance crashes. That is, what happens when you have a big collapse of the financial system that drags the economy, and the economy itself drags the financial system. And trying to make the point and collecting the fact that it's not that we don't know anything about those. Actually, we've been working on these things for 100 years, and there's a lot of modern economic theory that had been working on this even before the financial crisis, but certainly much more after. And so we try to collect in this very sharp, I think a reviewer in the FT called it a blessedly brief book, which I took as a compliment, in that, you know, our first version had 300 pages, but we managed to boil it down to 100 and few pages of just what I think some key principles, key concepts that one can use for macro financial crisis to understand. The pandemic was a different crisis, but heck, it's a great test because you can apply our principles and see how helpful they were. Now, there are 12 chapters in the book, each one with a different principle. I certainly don't have time to tell you all of them and how they applied, but they did. They all applied. I invite readers to buy the book and have a look and try themselves. But let me tell you, there's 3 parts of the book, and so let me tell you 3 applications right now. The first one is the run-up to the crisis, and some of the factors that tell you is a crisis coming. I think because crises are inevitable, Filippo, and they always come.
Yeah.
On the run-up, one thing we noted was that the crucial role of banks and of a banking system, and the extent to which there's a connection between marking-to-market assets and the amplification that comes with that, and the role that non-banks performing the role of banks have. On this, I will just briefly say that we did not have the run-up to a macro-financial crisis because of all the regulation that we had before. And so on the run-up phase, if you want, to the pandemic crisis, there was reasons for this not to become a macro-financial crash, as it turned out not to be. And I think if you understood the principles of the centrality of banks and how they work that we explain in the book, you would see that a macro-financial crash was probably not going to happen as it did. Second is that the diagnosis of propagating factors. And here, one thing that did happen was what we talk about, the concept of strategic complementarities and amplification, especially as it relates to flight to safety. And so I apologize, those are 3 jargony words. But what we mean there is the fact that when you sell, I want to sell, how that amplifies things. And that desire that I sell when you want to sell is one that arises in some context. And especially when you run for safety, how I want to run after you, seeking the same safe harbor, and how that can be lead to a meltdown of financial systems. On that one, I think that was very much the case in 2020 when you saw the flight to U.S. Treasuries. Here, you really have to, having criticized policymakers before, let me give a big applause to the way, especially central banks, but also fiscal authorities at the time or governments, reacted even internationally. For instance, the central bank swap lines are very important at that, but not only, especially emerging market central banks did a phenomenal job at fighting that tendency that often led to meltdowns and stopping that flight to safety. That did happen, but we counteracted it. And third, we talked about the interventions, the importance of interventions in a crisis of policy and how nimble interventions have to be. And here again, in stopping the macro-financial crisis, I think the deficits and the spending of 2020 was a very good idea. I think looking back, we probably didn't target it as well as we should. Well, not looking back, even at the time, we knew we weren't targeting and we could have saved a lot of money, I think. But still, the importance of running a deficit very quickly to compensate when you have this massive increase in savings by people who are locked at home. An important lesson that, for instance, we learned from the Great Depression was one that was used here, the understanding that when you have a huge shock to private savings, you need to offset it with a huge shock in the opposite direction to public savings with deficits, and to do that very quickly. And we did that in 2020. So the combination of before the identification of the flight to safety, the use of fiscal lesson in 2020 was, I think, a great application of the principle in our crisis of why this massive macro crisis was not a crash course, was not a macro financial crisis of the type that we discuss in the book with Marcus.
Thank you. And that's very helpful. And also the reminder that we will always have crashes at some point, so we just have to be prepared for it. Well, Ricardo, it's been kind of wonderful having you today, and also for kind of your explanation of the inflation kind of cycle of the last few years, and also what went wrong and what could have been done differently, but more importantly, some of the lessons that we learned. So thank you again for your time, and to our listeners, until the next time. Thank you, Ricardo.
Thank you very much.